We have planning for entrepreneurs. We have planning for C-suite corporate executives, Wall Street people. We have planning for people that are middle-level managers that are very, very successful, that are 5 to 10 to 15 years in or 15 years from retirement.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
All right. This is John Smallwood, and this is Money Isn't. And one of the things that I wanted to discuss today is the concept of what is a maximum wealth plan, right? And I believe there's what we call a maximum mindset. And if you don't have a maximum mindset, chances are you won't have a maximum output of a wealth plan. I just finished recording a podcast with like 6 of my advisors where we were talking about what are the top 10 things that people miss in their 20s, right? And it made me get to a point where I know everybody wants to have a ton of money, right? That's what everybody wants, right? Because with money comes all the things that you want to do or not do. Like, I don't want to go to work. I want to go play golf every day, or I want to go on vacation every day. In order to do that, I mean, you could do it without money. It's a lot more fun with money, okay? So a couple years ago, I created this tool that we have, which is it's a download, and we're going to put this out as a download because it's a wealth curve mindset maximizer, right? And you need to understand, if I'm going to have the maximum output in my wealth plan, there are certain macros, there are certain things that need to be in alignment. And if they're in alignment, the chances of achieving that success go up exponentially, okay? The chances of something taking away that success goes down. It doesn't get rid of it completely, and it doesn't mean you're going to have success either, right? But if the odds are greater because I'm doing the right things, there's a higher possibility of success, right? If I'm trying to lose weight and I'm eating 4,000 calories a day and I have, activity level of, less than, let's just say 1,000 steps a day, and I don't work out, I don't think I'm going to lose weight unless I got an amazing metabolism, which I don't think that's going to be the case with that kind of activity, right? There's certain things that are just intuitive, and there's certain things that when you actually measure it, you realize that you may not be getting the results that you want because you're not effectively measuring the outcome, okay? So what I found, I've been doing this, I just realized when I'm recording this, it's May 2024. I officially joined the wealth management business full-time in May of 1990. So it's 34 years of being full-time in the business. I actually entered into the business part-time summer of 89. So it's almost 35 years, but 34 is good, okay? And what I found is during that time frame, if people had certain elements of their plan in the right proper balance, they were my more successful clients. And those that are retired, that we've taken full cycle from, starting with little kids, putting kids through college, working and being retired and accumulating wealth, there's been a lot of things that went awry during that time frame, and having the really good plan helped them maximize those opportunities and those obstacles when they came up, so they're still in a great spot. So what I wanted to share with you today, and I'm sharing my screen, it's called the Wealth Curve Maximization Mindset on screen 1. And the theory behind this is, when I graduate from college, whether you're a physician, you're a corporate executive, you're an accountant, you're a Wall Street person, money doesn't come. You didn't have a class in money management. You didn't have a class in college on savings rate. You didn't have a class on how to build a proper wealth plan. And everything that you read is full of opinions and biases and hearsay. And it's not really based upon factual information. My goal of doing this today is I know that if you're still listening to this conversation, you want to have money today. You want to have money into your future. And I know that if you're willing to follow a plan, a really good plan, you're going to be successful. But it comes down to it starts off with, where are you right now? Okay. Are you married? You're not married? Do you have kids? Do you have 8 kids? Do you have 2 kids? Do you have 3 kids? Are your parents still here? What really is going on? Are your grandparents still here? Is there financial pressure from many of those? You have siblings that aren't fully launched. You got to understand the ecosystem, the environment that you're in as an individual, okay? And maybe I'm newly married and I'm going to have, my wife and I, we've said that, hey, I want to have 2 kids, and my wife says 4 kids or 5 kids, all right? Well, those are 2 different plans, all right? A 5-kid plan is different than a 2-kid plan, right? It has different impacts. It's different wealth requirements. It has different, just different way of thinking, right? It's not important. That's not important, but it's you understanding when you make certain decisions, or you're going to be making these future decisions, what's the impact, right? I could be right now working for a company making $150,000 a year. Financially, I'm in a good shape, but I'm not happy. And I really want to go out on my own, and I want to be in a business because the people I work for are morons. And I've heard this 1,000 times in my career, if not more. And people go out on their own and they make their own businesses. And if they're really focused on it, they have the right way of approaching it, capital or no capital, they are successful in that because they're focused on what they want. And my journey in wealth management is, it's more important to understand what the individual and the family, the melding of that family, the husband and the wife, the individual, what is it you really want to achieve? And when you get clear on what it is that you want to achieve, then you back into the plan. If you want to be a business owner or an entrepreneur, that plan is different than somebody that says, hey, I'm really happy with where I am. I have a great base salary. I make really good bonus and I'm in control and I'm going to ride up this corporate ladder and get to be in the C-suite and I'm going to have all these future options. That's different than somebody that's going to go into their own business. You're going to take a different approach, right? In our planning, the way we've designed our planning is we have planning for entrepreneurs. We have planning for C-suite, corporate executives, Wall Street people. They fill into that same category. We have planning for people that are middle-level managers that are very, very successful, that are 5 to 10 to 15 years in or 15 years from retirement. And the setup is really different than that, than those other first 2. And then we have the young up-and-coming either entrepreneur or corporate executive who's going to rise through the ranks. You want to make really good decisions right now because the decisions you make at 25 versus 30, at 40, at 50, and 60 really dictate where you're going to be in the future. But if I approach it from maximum mindset, and what is maximum, then I'm going to have a successful plan if I approach it from the maximum mindset. So the form that you can download kind of walks you through a thinking, right? And based upon who you are, there's going to be different answers to the maximization. So if I make $100,000 family household income, my maximum savings rate should be 15%. If I'm not saving 15%, I'm not going to make it to where I want to go. It's like putting fuel in a car. Okay. If I want to drive 400 miles and my tank, I have a range of my car that's 450, but I only have a half a tank of gas and no money to pay for fuel, I'm not going to make it to my destination. So in the book, It's Your Wealth, Keep It, chapter 3 talks about savings rate. Okay. But it talks more about the psychology of the savings rate. A person who saves 5% of their income has a different psychology, a different mindset than somebody that saves 15%. And the person who saves 5, if they're saving in the same investment vehicle, will never accumulate enough money to maintain the standard of living. They can't figure out why. All right. So our job is to kind of look at it and say, who are you? And how do I go into the rest of your plan and help you find the money and the leaks and the crap that's coming out of your plan and recycle it back into savings, right? So in this thing, on the savings rate chart, what am I saving right now? What's going into a savings account? What's going into permanent life insurance? What's going into a retirement plan? What's going into a non-qualified brokerage account? Maybe I'm paying down debt that I have. Maybe I'm accelerating the debt into student loans. Maybe all of those are forms of savings, right? And, if I'm just servicing a traditional loan, a principal and interest mortgage on a house, that's not part of my savings rate. That's part of my lifestyle rate, that house, right? But if I said, I got my $300,000 mortgage and the payment is $2,500 a month, just using it as an example, don't know if that's right, but I pay $3, the extra $500 a month is savings. And the idea is to understand, okay, where am I saving money? And what percentage of my income am I really saving? And when I go up that chain, I go from 200 to 300 to 500 to 700, that, 15% at 100, 20% at 250, 25% above 500, and really 35%, 30% above that $1 million mark. And if you're, earning $10 million a year, you're usually reinvesting back into your business, which is a form of savings also. Okay. But it's a form of how are you leveraging your wealth? How are you putting money to work? I mean, if you're any type of a corporation, you're putting money back into research and development to further have a future of more and more products, or investing in new product lines, or whatever it is. Like, everything's a form of savings, right? But the key is savings rate must be maximum for what you are doing. Now, let's say I jumped off the ship and I'm a business owner tomorrow, and yesterday I was working for the corporation. I'm probably going to be putting everything back into the business for an extended period of time until I get it optimized. And when I get it optimized, meaning it's now profitable and I can actually take a salary, that's one of the things you have to start doing. But that's a whole other separate conversation from this, right? So the savings rate has got to be optimized. I've got to have... Here's a problem that I find out. Like, you're renting an apartment right now and you're spending $3,000 a month on rent and you make less than $100,000. The odds of you saving any money is pretty darn low. If I own a house and my principal interest taxes, and let's say HOA, fee, let's say it's a condo, okay, is greater than 25% of your gross income, the odds are you're not going to have enough money to put in other places. And this happened with interest rates where they are right now. It's happening at a more frequent rate. But I can remember in the early 90s, I get introduced to people in these mega mansions out in these, zip codes that are close to me, that are these, 5,000 square foot houses. And I'd pull up in, my nice car and go in and meet with them, and then walk in and it's like little tykes in the family room furniture. There's no furniture. There's no drapes. There's no landscaping. There's not a deck on the back. And they bought the maximum house that they can buy because the banks would give them 36%. And I knew there wasn't anything I was going to do from a financial planning perspective because they were strapped. And some of those people, grew into their house. Some of them never did. Okay. And if you know where you're going, and like, let's say you're a business owner and you're putting all the right savings and investing back into your business and your income's going to go up by 25% a year, that's different than somebody that works for a corporation that's going to make 3 to 4%, increases. So that house at 25% becomes super important. Now, cash reserves. We're building towards this, right? You do not wait to get started on this, right? But a rule of thumb is really, really important, is having liquidity of about 50% of your annual lifestyle, your annual burn rate, right? So if I'm sitting here and I'm making $100,000 a year and my lifestyle is $50,000 and I'm, got money going to taxes, money going to savings, money going into savings. If I don't have $50,000 or so liquid or available, and I have a loss of job or I have an issue somewhere else, furnace breaks, whatever it is, air conditioning goes down, sewer line goes down, as we talked about on an earlier podcast. I don't have the money to go back and improve my situation, and that's going to cause credit card debt. Now, if I just got the job yesterday, I'm not going to get there. I'm not going to build up the cash first and then go put money in other places. What I'm going to basically say is, hey, I'm making $100,000. I got to put $15,000 somewhere. Well, let's put money to maximize the 401k match. Let's put money in short-term savings. Let's put money in long-term savings. I got to be building a plan, and I'm working towards it. Okay? The next piece in this max cash reserve is maximum umbrella liability protection. Your assets and your future earned income is what you're protecting with an umbrella liability policy. 9 out of 10 people over the last 30 years that come into this office, 34 years, do not have proper umbrella liability policy. And what that is you have your homeowners, you have your car insurance, you have your jet ski insurance, your boat insurance. There's liability limits on that. And you want to put an umbrella policy. Let's say there's $500,000 on all your houses and all your cars and everything. You want to put $1 million to $2 million, depending on your income. Might be 10 million, might be 100 million of umbrella liability on top of that. And I tell the story. Let's say that yesterday or 20 years ago, I was driving in the car for a second and I was drinking coffee, shifting and texting. And I ran a red light. And I maimed a really successful person who was making $1 million per year. What's going to happen the next day? He's not dead. He's disabled. Maimed. He's disabled. I'm probably going to get sued. And let's just say, for an example, that my car insurance covers me. I had really good coverage. It covered me for $100,000, $300,000 per accident. So $300,000, $100,000, which I see commonly, is if I'm in an accident with one person, it's going to pay for $100,000 of liability. If I'm in an accident with more than one person, it'll cover me for up to $300,000. Is that really enough? So let's say that I was making $200,000 and that guy was making $1 million. And I only had $100,000 worth of liability coverage, and he sued me for $5 million and won. Where's the $4.9 million coming from? Out of my future earnings, out of my cash that I've saved up. That liquid reserve is long gone on the attorneys. My house, maybe gone. Right? State of New Jersey. Depends on the state. Florida, different, right? These things are really inexpensive. But if you don't have maximum coverage for your situation, And that's the key is what do I have now? What's maximum and what should I have? All right. Maximum disability insurance. That same person, I'm making $200,000 a year 20 years ago, and I become disabled. I've got 4 kids at that point in time, a mortgage, house, and I became disabled. I didn't, so I'm here still. What would have happened if I didn't have proper disability protection? All my savings would have stopped. All right. My assets would be taken away because I'd be spending down my assets because 20 years ago I wasn't ready to retire. Most people aren't. All right. It's catastrophic. So there's group, there's personal. You might make $500,000 a year and your group only covers you for $10,000. It's not enough. You're not insuring the goose that's laying the golden eggs. You are laying the golden eggs. Okay. Life insurance. There's permanent, there's term, there's universal, there's a hybrid of all those different strategies. They're all beautiful, right? If they're used properly. But the key out of the gate is, if I died yesterday, is Sharon going to the insurance company and asking, and the insurance company is saying, Sharon, what do you need? And then she's going to go through like a long, blown out, stupid needs analysis to say, well, I only need this. And the insurance company go, oh, here's that check. Rather than asking the question is, what's the maximum that I could get? Imagine the day after she could go and say, you get to choose how much you want. All right? You're choosing how much you want today. Is she going to say, I only need $1 million? Or is she going to ask for the maximum? Or are my kids going to ask for the maximum? Or are they going to just say, oh, no, we don't need any because we're successful? Think about the stupidity of what I'm basically saying for a second, right? You know, the most important asset in the room, listening to this podcast, listening to this YouTube video, listening to this wherever you listen to stuff, you are the most important asset. And underinsuring the most important asset is not a smart thing for long-term wealth. The wealthiest families understand and own maximum insurance on everybody in their families, okay? There's a very successful investor, I believe his name is Warren Buffett. He owns a bunch of companies, but one of the things that he does is they buy life insurance policies, existing life insurance policies from people that don't want them anymore. Why are they buying them? Because they're really valuable and there's a predictable strategy. Okay, you got to understand the value of what that is in the long run. And everybody on this planet will move from one dimension into another dimension, right? In death. Who knows where I end up? But when I pass from this one to the next, what did I leave behind as my legacy? How do I love my family? How do I protect my assets? Like I'm working with somebody recently where they're worth, about $200 million. And I find this hard to believe, but they didn't have a strategy and they were really unaware that in 9 months from date of death, they owed roughly $80 million in estate taxes under the current estate tax law. And there was no liquidity to pay for it. So what took this guy 65 years to accumulate is going to be gone with the stroke of a pen, 90 days. That all can be solved through proper planning. And everybody gets into the mindset, well, it's, all this hang up. The question is, what do you want? We're talking about what you want in life. If things go bad, I want to have the maximum. Well, life insurance, it's always going to end in death. It's the only thing that I know that's true. Taxes are not necessarily, everybody say death and taxes, right? I think it's just death. And sometimes I feel like the Grim Reaper, but the reality is, I hope I die at 150. Will I be insured? Or will I have a temporary plan that crapped out at age 56, because I'm 56? Do I rent my coverage or do I own my coverage? Maximum is right now, if I'm opening up a business and I'm a young person, I buy the maximum amount of term insurance that's convertible to permanent in the future. Because once I lose my insurability, if you buy really good quality term insurance, you can convert it to permanent without an exam in the future at the rate that you get today. So if you get ultra preferred and tomorrow you're uninsurable, you can convert it to ultra preferred. If you're uninsurable, you can't get it. Maximum wills. I'm talking about it, the $200 million estate plan, right? Versus the $200,000 a year guy that doesn't have anything. Those are two different strategies. But you got to have wills. You got to have trust. You got to have guardians. You got to have advanced healthcare directives. You got to have durable power of attorneys. You want to control where your money goes and how it goes to them. One of my biggest pet peeves in poor planning is money somehow ends up in the hands of the wrong people after death. You know, your child inherits money from you, and he or she unfortunately passes away early, and then it ends up in the hands of another family that wasn't even linear or generational to your wealth. Is that what you want? Or do you want your money to go to your family and to your charity? Like in my personal wills, if nobody's here, we have a foundation that gets set up for youth confidence. Like I don't want my money going to people that are not going to benefit from it. I want my money to go where I want to go, and I want to control it, right? So it goes to the right people when it has to go there, but I want it to empower future generations. You got to be intentional in what you're talking about. Long-term care. How many people do you know whose grandparents lost all their money to the nursing home, which is a corporation? That's a transfer of wealth. If I do not have proper protection or enough income that exceeds my current lifestyle, if I'm retired and I can generate $200,000 a year, but I live on $100,000, do I need long-term care? No. But for a couple $1,000s a year in premium, I get to use somebody else's money when that event happens. Or if it, you know, I tell a story all the time. I either wake up in the nursing home or I wake up in the funeral home. If I wake up in the nursing home, it's a long, drawn-out battle of people trying to take my money and keep me alive. I don't have the right will and the right trust that says, advanced healthcare directive, if I am incapacitated, pull the life support. Pull it. Protect the wealth. Protect the people. Let the people move on. You want to get really clear on this stuff, and you want to communicate it to the people that you love, right? Here's what I want. And then you got to look at what are all the things, what are the goals that I've set, right? And goal setting drives the future wealth, right? I want to have a country club. I want to have a second home. I want to have a boat. I want to fly private. I want to retire at 40. I want to put all my kids through college. I want to start my own business. Think about what you want and when do you want it? And you get to design what you want, but you got to understand what is out there. What are the pressures that are coming at you? That's why we started up with the family. Like, let's say you're 5 years into marriage and you're 28 years old and in-laws go down financially and you got to take care of them. What impact does that have on your future wealth? It's massive. It's like crabs in a bucket pulling you down. All right. And then the lifestyle. So if everything's in motion, right? I'm making money. I'm saving the right percentage of my income, paying the least amount of taxes that I possibly can. I have great wills, great trust, great life insurance, great disability, have the right level of protection, am clear in what my financial goals are. The math should be, lifestyle should be about 40% or under of the gross lifestyle, depending upon where you are. Because that lifestyle, depending on your goals, let's say that your goal is, hey, I want to create $1 billion for myself. That's a ton of money. And there's a lifestyle that comes along with that. But I need, I need a ton of money to live. Like, there's a certain percentage that I'll put it $1 million, right? In $1 million frame for a second. Somebody comes in and they say, I need $30,000 a year to live my lifestyle. That's easy. 3-4%, simple. Oh, I need $70,000 a year from that. That's you're not ready. That lifestyle's too much. You haven't saved enough money. You're going to run out of money if the markets go sideways, if you live too long, if inflation is high. There's all these things. So if I keep the lifestyle in check within my means of what I currently have, and I increase lifestyle as I make more money, but I increase my savings rate, and I increase my protection, and I increase my lifestyle in step with each of those variables, financially, you're going to be fine. If you undersave and over lifestyle because you're afraid you're never going to have any money, you're actually getting what you want to have happen. So the reason why I'm bringing this up, I think one of the greatest things that you could do is sit down and understand what is maximum for you versus where are you now. In this form, this conversation, if you want to have this conversation, one of our qualified advisors can actually have this conversation with you on a free, no obligation basis to do any planning with us whatsoever. But we are really good at having a conversation about what you want. And a lot of my clients over the years say, I'd like to come talk to you because this is the only place I can talk about money. I can't talk about money in my household because nobody's successful. Everybody's weirded out by it. We love it. This is what we do. We want to see you, if you're worth X, we want to see you become worth times X, right? X times worth, whatever it is. I want to see more money. I want to see more enjoyment. We want you to become our best clients, all right? And when we can have an open conversation about what maximum is and then put that in place, you have a successful long-term plan. That's what I want you to have. This is awesome. Thank you.